So good
Okay,
day.
so over to you now.
All right, thank you so much. Welcome every one of you today. I hope you all enjoyed yourself. So we are in the last session, the concluding part of the accounting class. So to finalize the remaining and the main account, which is the final account. So we need to take our time to be able to explain this because this is the account that every stakeholder will need for them to make decisions with regards to the trading, to the financial statement. So we started off from um, compiling all the transactions within the year, to compile it, record it in a ledger, from a journal to a ledger, from a ledger, go straight to trial balance, spoke about all these stages. These are stages, these are processes. So from your journal to your ledger, from ledger to your trial balance. Then from your trial balance, you will now bring it to this final account. And we call it final account because this is the last stage at which all the stakeholders, either the government, either the owners of the business, the employee, the public, the creditor, the debtor, the customer, everybody, this is the account they want to see and make their own decision. Also to check if their account, if the company is doing fine or not. You have to check the health of that system, of the of the company. So final account, as the name implies. So these are accounts prepared at the end of the period. At the end of an accounting period, we also do. I remember I told you about when it comes to accounting period. It's a period of 12 months, a year. So it depends on each company what period you want to choose, but it must be 12 months, 12 calendar months. From January to December, which most likely everybody used to choose, so that you know that from the beginning of the new year, to start another resolution, start another target, to have another budget thereabout. So it is the account prepared at the end of the accounting period that tells us what? It tells us the position, it tells us the health, it tells us the state, the status of that company. The financial statement reveals everything about the company. It is doing fine, it is doing better, it is doing worse, which we will know from this final account. And we have the trading, profit, and loss account, and we also have the balance sheet. We also have more other final accounts, but because of this course of this lecture, based on our syllabus, we'll be restricting it strictly to just trading profit and loss account and balance sheet. We also have cash flow. We also have statement of change in equity and all other ones too. But the main, we have the trading profit and loss account and we have the balance sheet. So let's go on. So what is now the trading? So the trading profit and loss account, we have the trading aspect and we have the profit and loss account also. So what is trading? What do we mean by trading? So this account prepared for the purpose of finding, you are preparing the trading just for you to find out your gross profit or your gross loss. You want to know if you are making profit or loss. So trading is always restricted to the business alone. The expenses incurred, direct expenses incurred on your stock, on your commodity, on what you're selling, your other services or your product. So just want to know the gross. That's why it's called gross profit. So knowing all this. So is the account prepared for the purpose of finding the gross profit or loss of the business at that accounting period, or it could be a particular period, it could be quarterly, 6 months, depending on what you want. So, and what does it contain? We have the opening stock, we have the purchases, that's on the debit side. If you are looking at the key format, you have your opening stock. So that's what I'm talking about. You're able to know what you have based on stock, opening stock, as you can see. Opening stock. That's the stock that was left last year that you are bringing forward to this year to continue the business. Or the stock that was left last month, that no stock yet to be sold. but now carrying it forward to the following month or the following year for operations to continue. So that's why we have the opening stock. And with the purchases, as you can see the purchases. So when you have those stock left yet unsold and you are carrying forward to the following year, then during the course of the year, during the period, there will be some purchases that you've made. So you have those purchases to it also. So that's your play stock, the one you have left with your purchases too. During the year, you had it too. And at the end of the year, most likely you must maybe there are still some stock left unsold. So you do what? You take it away from it. You take it away, you minus it from it for you to load the actual goods that was sold. And on the credit side, we have your sales. So you can see this stock is talking about the same operation, the same stock you have. The stock you have last year that you brought forward to this year to continue selling, and the one you purchased during the year, and at the end of the year, there will be some stock left. So those who you sold, then you now have the sales. How did you sell it? How much did you sell it? That's your sales. And let's return it inward shows that maybe there are some sales you made, there are some products that were maybe no good or default or it was mistakenly supplied to your customer and they return it. You have to let it from your sales. So this is just to ascertain the gross profit from the business, and that's what the trading is. Why? So here this is the format for it. As you can see on the debit side, the opening stock, you have it, you have your purchases, you have it, then you let return outward. Return outward. That means when you purchase some things and maybe it was not what you ordered, or you paid money, it's not what you ordered. You need to remove it from your purchases because it's not what you ordered. You take it off from it. As you can see, let return outward. Sometimes too, you have carried inward too, because sometimes when you purchase something, the cost of transporting it also is added to your purchases because you need to recoup your money back. So you're paying money for the transport. So you had your carriage inward to your purchases. So that when you sell it, you factor in the cost of transportation of that good. You factor in your sales so as not to make loss. So when there's always the carriage inward, you had it to your purchases. Then return outward, as I've said, you return outward, and there are some returns from the purchases you made, and you return it back to the supplier. You return it to the manufacturer. So you let it from your purchases. So when you let it, you have the goods available for sale. That is the cost of goods you are dealing with money here. So cost what you have, your opening stock with your purchases and everything in total. This is the total goods that is available to be sold. Then when you remove your closing stock at the end of the year, the final day you are making the account statement, the remaining stock left unsold. When you deduct it from all the goods available, that means what you'll be having is the cost of goods that you've already sold. The cost of goods that you already sold. So when you now know the cost, then when you make the sale, that's why you have it on the credit side. So when you had your markup, when you mark it up, adding your profit to it, that's what the sales. So the cost of goods is this so number XX. And that same goods, you sold it at this so amount. When you deduct it, it's on simple math. You know your gross profit. That's for trading aspect of it. We have the return inward. That means some sales you made to your customer. And maybe as you have the return outward for purchases, you can have return inward also for sales. Sales you made, goods purchased by your customer. Cover that it was maybe due to one or two things, due to expiration, due to wrong order, or anyone, they return it. They return it to you. So you let it from your sales because you can't hide it, because you have to return. You have to give them back their money. So that is for the trading. Then the profit and loss account. This is now the extension. So you don't just stop at the trading alone for you to know your gross profit. You now need to know what exactly is your net profit. So this profit and loss account here is need to tell us how much exactly is now our take home. How much am I taking home? How much am I gaining after factoring all other expenses apart from the one that strictly concern the business? That strictly concern the business. All other factors we need to consider. So this is an account consulted by a business organization to show the net profit or loss. It shows on the debit side the expenses incurred, all the expenses you incurred, all the expenses incurred, the lighting, electricity, salary, and everything. You need to factor in that to know if truly. Sometimes you can make profit, gross profit, and at the end of it all, you can now make your net loss when it comes to removing all the expenses. So all these things need to be factored in. Needs to be factored in. So, and here is the format for net profit. It's just an extension, not like the separate account itself. It's just a continuation of the profit. As you can see, the gross profit that we have over there just carry forward. Then you have the salary. These are expenses. Either you sell or you don't sell, you will pay salary. So that's why it's so necessary for you to make sure that you make sales. It's necessary that you get more revenue so that you're able to cover up your salary, the salary of your staff. So these are expenses. So salary, rent, either you make sales or no landlord will tell you that if you when you make sales you can pay rent. Don't make sales, don't pay rent. They don't care. So these are fixed. They are more or less like they are fixed costs. So you will deduct your rent or rate. Motor expenses too. If you've been using your vehicle to do marketing, to do all these ones, so expenses incurred on the vehicle. These are expenses too. You also factor it in. You align nail it against, you align it against your gross profit. Office maintenance, insurance, advert that you do or postage you do, traveling expenses, electricity, legal charge, other general expenses that cannot be mentioned. You factor everything. At the end of the period, when you sum up all your expenses and it is less than the gross profit you realize, that means you are making a profit. But if your expense is now more than the gross profit, it means that you are on a loss. You are making loss. So all these things needs to be factored in. So what's the purpose of trading profit and loss account? It's just for us to show the profit of the company. So as we know, this is at this stage, it is when all the stakeholders now start looking at what the accounting is saying, the financial statement is saying. They now start looking at it, the financial statement, what is it saying? So does it make profit for them to make decisions? How much profit is it making? So if we can also make sure that we scale up or make some decisions, this and that. So to show the profit of the organization, we want to know how profitable the business is. It's very profitable, or the profitable is just so marginal. So we need to know. Also, we do it for comparison with other years. You look at your financial statement of last year. Am I doing better this year? If you look at the comparison, am I doing better? So if I'm doing better this year, then I need to step up again the following year. So you give yourself again another budget, okay, for next year, I'm gonna make sure I meet up with this target. So the financial statement, this final account, help us to do those things. So these are decisions made. These are decisions made. So for income tax assessment, also for government, so to be able to know what tax you will pay, or the government to also look at it to be able to assess you and able to charge you on what taxes you need to make, and also for management purpose and many other purposes. Many other purposes. All depends on what every stakeholder wants from the financial. Statement. Then we now have the balance. The operation that happens, the profit and loss account shows that. The trading profit and loss account shows that. It shows that for us. So But for balance sheet only tells us the position of the company as at that end, as at that day. Profit and loss account shows all the transactions that happen all through the accounting period. That's what trading profit and loss account shows. All the transactions, every transaction being summarized. As we say, they summarize everything. You can see it's just in 4, 5, or 6, or 10 lines, but you can have the thousands of transactions during the whole year. How much is now being summarized, being classified, being organized, being so as you're now doing it, so you now have at the end of it all, paying your final account, you can now be maybe everything is summarized into maybe 20 or 30 line items and thereabouts. Why balance sheet shows the position of the company as at a particular period, as at the end of that year, if the financial period, accounting period of the company is 31st December 2024. Then the balance sheet will show the position of that company as at 31st December 2024. I always like in balance sheet as being a picture. When you snap a picture, so what you look like in that picture, it is exactly how the balance sheet looks. That's what balance sheet is saying, telling us the picture of how the business looks like. So what are the things you see in balance sheet? We have your assets, we have your capital, we have your liability. As you remember, the first account, what we're doing our account at the beginning, that is an accounting equation. Assets equals to capital plus liability. So that is the balance sheet. And this balance sheet gives us that picture of assets equals to capital or equity plus liability. So balance sheet statement draws up at the end of the financial period, setting forth various assets. It shows us the assets, the amount of assets, the numbers of assets. It shows when you have a loan, another period. Your liability, it shows it. The capital, how much you invested personally into the business, it shows it too. And it's well arranged. So when we come to assets, we have the fixed assets and current assets. And these days, it's called non-current assets. Fixed asset is also called non-current assets. Based on the standard, International Financial Reporting Standard says no more use fixed assets, but now use non-current assets. So assets are resources, as you know, property or possession of an organization. They are owned by the business and expected to be of some future benefit. So these are assets you use, you employ to generate revenue for the company. So these are the assets you use for your operation that is being shown in the profit and loss account, the trading profit and loss account. So these are the assets we are using, we employ, so that you get more economic benefit, so that the business will grow, so that you make profit. And so non-current assets or fixed assets, your land and building, furniture, furniture and fitting, of machinery, generator, the motor vehicle, these are fixed assets or non-current assets. And they last for more than a year. They last more than a year. These are assets that you enjoy the benefit for more than a year. These are long-lasting assets which are used for the purpose of creating productive capacities. They are acquired for you within the organization and not for sales to customers. We should know that when it comes to assets, these assets we're talking about or non-current assets, they are not for sale to customers. So let us not mix our fixed assets to stock. Stock is what you are using, you are selling, that's your operation. So if a company is selling car, note that the car, even though it's an asset, a fixed asset, note that car, because they are into selling of car, that car is their stock. That car is their stock. It will not be added as a fixed asset. So we must not mix, it will not added as a fixed asset thereabout, even though stock too is an asset, but you won't classify it as a fixed asset. Or if a company is selling laptops, just know that that laptop is a stock. It's not the asset because they are trading in with laptops. But other things you now use in order to generate more revenue, they are using to get for the operation of the business. They are using that's not for sale, but it's for the management use for use in order to generate profit to carry on the business operation of the company, and it can be now be regarded as fixed asset. As I said, the last more than a year is an asset that are more than a year period. That's why it's called fixed asset. It can be 3 years, 4 years, 5 years, 10 years, thereabouts. Why current asset is asset that are usually for a short period of time and just within a year. It's just within a year. Just within a year. They are within years. And they are easily converted into cash, which can be easily converted into cash. So we have your stock, as you have said, and your man, this stock we're having here will be your stock, the closing stock at the end of the year, because as I said, balance sheet shows the position of the company. So the stock at the end of the accounting period, the remaining stock available, you need to value it, and the balance sheet will show it that, oh, we're having this value of stock available that we're carrying forward following accounting, the next accounting period. You have your stock, you have your cash at bank, you have your physical cash too. These are there. Treasury bills. Treasury bills are bills within a year. Thereabout your debtors too. Your debt, those who are owing you, you also have it as your current asset. So let's know all this classification. Let's know what will be under fixed asset, and let's know what will be under current asset. Current assets are assets within a short period of time, usually within a year, just within 1 year. So your stock, when you have a stock, it's obviously that you want to sell those stock within a year. Your bank, your cash, treasury bill within a year, your debtors, you want to collect your money instantly within a year, and the like. So same thing up, the fixed asset is more than a year. Your land and building, you expect to use your land for even not 50 years more. You want to use your furniture, you always value it to use it for 3-4 years. Depends on how you want to value it and value your depreciation. Your plant and machinery and your motor vehicle, you don't want to just use it just within 1 year, more than 1 year. Just one, you like to use it more than a year. So these are fixed assets and current assets. So these are based on assets. Asset equals to capital plus liability. So, and here's the arrangement for assets. In every financial statement, there will always be an arrangement. That means you don't just arrange it anyhow. It's either you arrange it based on realizability, that is how those assets can easily be converted into cash. That you can arrange it in that way. And you start from cash, which is already converted, already in cash. Your debtors, that is, ask your debtors to pay, they pay you in cash too. Your stock, sell it too, and also easily be converted to cash also. So these are current assets. And your fixed assets also arrange it too. Your investment, your furniture and fixings, your motor vehicle, plant and machinery, and land and building. But most usually, they make use of in order of permanence. The asset can be arranged in order of permanence. How long they can be, how they can last with you. Land will always last more longer than any other thing. So your plant and machinery too, so your manufacturing company can last thereafter next. Your motor vehicle next, your furniture and fitting comes next, your investment, which is the fixed asset comes next. Then your current asset, your stock will still be in your hand, but your debtor comes next, your bank, then your cash. Because everything you are talking about cash. So cash comes last. And your bank can easily get your money from your bank, which is next, then your debtor, then your stock. So these are the way to arrange assets. So go ahead and check financial statements of any manufacturing company or any company, it is always being arranged in this order. They arrange it not the card. So then the other side of it, when we say your asset equals to capital plus capital plus liability. So the capital, the liability aspect of it, as you can see. So we all know what liability is. It's just the financial obligation of the company. Liability is the owing, money you borrowed. This is the obligation arising from the past transaction. It is a claim by the outsider on the asset because since you borrowed money from an outsider, from a creditor, you also use it to buy those assets we just talked about. Either you bought plant and machinery, or you bought furniture and fittings, or you bought land or thereabout. So you must have borrowed money, or you use it to even to get your stock also. So these are obligations arising from the past transactions. So and you owe it to duty of care to ensure that these loans are paid back. These loans are paid back. So we have your debenture, you all know debenture. So your loans, your creditors, and everything. And this liability also, as we have asset that is divided into fixed assets and current assets, or we call it non-current assets and current assets. Same thing also applies to liability. We have the long-term liability and we have the current liability. Long-term is a long-term. That means it's more than 1 year. The liability that becomes due for settlement for more than 1 year. Your debenture, if you go into debenture or bond, it's about 4 years for payment, for repayment. It's different from treasury bills. Companies invest in treasury bills. And the longer it is, the higher your profit, the higher the interest you enjoy also. So either you go for the short term, which are treasury bills that you always have, or commercial papers, or you go for a long term, which are bonds and debentures that have interest. So these are long term financial obligations of the company. So, and they are due for more than 1 year. Why the current liability is just the obligation with liability within a year. Within a year, becomes due for settlement within 1 year. So they are paid within a short period of time. Quickly, the creditor, especially when it comes to your trade creditor, you order goods on credit. The creditor will never want to now say you want to wait in the next 2 years before you pay him back, because he also needs the money to continue his own work. So trade creditors, overdraft, accrued expenses, these are just liabilities that you need to settle within a year, within a short period of time. We all need this when it comes to business. Then capital, that's the amount used to invest in the business. Also, when it comes to big companies, we talk about equity. So that's shares. So that is what capital is. And all these liability and capital makes up your assets, because you must have used it to do one or two things which is now showing in your assets. So this is balance sheet as we have seen here with balance sheet, and this is the format for it. You can have it in this T format, or you can have it on a straight line format. You have the fixed assets at the left side. In order of permanent, land and building, you have a total amount, plant and machine. After factoring the depreciation, mind you, let's not forget that there will always be depreciation, because you need to factor in depreciation. It depreciates, all these things depreciate, except land that will not depreciation in it. For the plant and machinery, there will always be depreciation. After removing your depreciation, the balance, the net book value will be here. So it shows that this so asset, as at this day, as at this year, this is the value of it. This is the value of it. Motor vehicle, furniture, and fittings, you're linked to classify all those assets in one position. So anybody looking at the financial statement knows your fixed asset. They know the value of the company. They know what you have. They know the value of the vehicles you have, the value of the furniture, and the value of the investment you have. So these are things that make the users of financial statement to make decisions. most consider look at it from balance sheet and okay, should I go ahead to invest in this business? So creditor will look at it. Should I go ahead? There are some things, there are some indices they will look at. There are some figures they look at for them to know, okay, if they can invest or hold on the things you need to do. And your current asset, your stock, your debtors, then they look at your debtors and they see, you have many people owing you. What are you doing towards it? The owner of a business, when you now see at the end of the period, and wow, we have this huge amount of debtors. Then something needs to be done. In your cash, your cash and bank, you all know that one, that is the money that's within, that is with you. Then on the right side, that's on the credit side, you have the capital. That's the amount you have invested, you have put into the business. That's what we have there. The amount you have put into the business, there's the capital. Then the net profit of the transaction, the operation you did. Then the profit therein, you bring it in. So if you make profit, you add it to it. If you make loss, put it there, you have to deduct it. That's another. So you put your profit from the bank, from your profit and loss account, you bring down, because that's another money also realized. So showing the position and everything. Then the long-term liability, the venture bonds, as we talked about, and the current liability, there's some loans that you need to pay within a year. Your creditors, trade creditors, your bank overdraft. So typically, this is the format for your balance sheet. This is the format for your balance sheet. And this is what it is. This is what it is. So let's do one practical example to show what we just talked about. So let's look at this question. Let's look at this question. Let me bring it up. So we look at it together. Okay. So I hope you can see this. I hope you can see. So here's the question. As you can see, this is a trial balance. So all the transactions have been recorded, classified, have been grouped, and also been done, and the trial balance has also been done. As you see, like always showing the balancing figure. You can see in trial balance, debit side must balance with the credit side. We're having 322,890 debit side. Same thing we are having at the credit side. You can see. So it shows the balance, then you can now move to from the trial balance, you can make your final account. So we want to prepare a final account. It says there the following trial balance prepared. Okay, from the following trial balance, prepare a trading profit and loss account and balance sheet as at December 2023. From the trial balance that's been shown to us, prepare the trading profit and loss account and balance sheet as at 31st December 2023. So see all those line items. You have your capital, and all those, so that must be the amount you invested in the business, your stock. So this stock here is the opening stock. That stock is you carry forward, you brought in from last year to this year. You carry inward, that is the purchases you made, all those purchases you made, the transport you incurred in purchasing it. That's the carry inward. That's the carry inward, which will be added to the purchases. Your drawing, that one of the business has to withdraw from cash, maybe for personal use. You have your debtor, your creditors. There are some items that need to appear in the balance sheet, and there are some items that need to appear in profit and loss account. So you must know all those items for profit and loss account, that's trading profit and loss account, and those items that need to appear in balance. Just don't pick anything and start dumping it anyhow. You must know what is what? From the format or from the template, it gives you idea which item is going to where, your purchases, rent, and everything. So, without wasting much time, let's just go straight to the solution. So you can see here at the end of it all, it says stock as closed. That is the closing stock. The remaining stock at the end of the year, the value is 30,000 naira. Stock at close, 30,000 naira. So let's work. Let me open an Excel sheet. Let me divide this into two so we can work. Let me have okay. Good. Let me see if okay. Okay, good. So for my screen here, I have two windows here now. One to work and one for the question and one to continue the solution. To continue to do the solution of this question. So it says from the trial balance, prepare a trading profit and loss account. Prepare a trading profit and loss account. So let's have the title. Let's give it a title, a company name, XYZ, XYZ Limited. Let's just give it XYZ Limited. So XYZ Limited, let's have it. Then you have a trading profit, that's have the title, profit and loss account. XYZ Limited profit and loss account for the year. If it is balance sheet, it will be as that, but because the profit and loss account, we are looking at the whole year for the year ended 21st December 2023. So it was December 2023. Let's go with this on there. Where is the line? It's not 50. It's not 50. So since we are dealing with Naira, let's have about let's adjust it. So I won't be doing the T format. I'll be doing the straight line method, a drop down format, a straight format. I'll go on with that. Then we have our Naira note here, another Naira note here, another Naira note here. So if it is in dollars, also indicate that it is dollar. So that the person who is looking at the financial statement will know what value of money, what currency we are talking about, what currency we are talking about. So from our format, now let's look at the question. We have capital. First one, capital. Capital will not appear in your profit and loss account. So it won't be there. So just let's leave that one aside. Stock. Yes, stock will be in your trading profit and loss account. So just note that. So note those things that will be in your profit and loss account. But we need to first of all start with sales because we are using this straight line format. So let's start with our sales. Sales. What is our sales? Sales is, as you can see here, so I'll be color coding it so that you know that you don't leave any transaction we don't leave any transaction use. So let me color it with okay, red is so obvious. Let me put it in red. So sales is 176,000 naira. I'll put that one here. Let me instantly just put so 176,000 naira, 176,000 naira. Good. That's our sales. So that is sales for the whole year. Everything compiled together, 176,000 naira. So from that sales, any return? Was there any return by the customer? Let's look at if there's any return. Yes, we have return inward. So out of the 176,000 naira, customer returned 22,050 naira. 2,050 naira. 2,050 naira. Just put. So anything in accounting, when you see bracket, just note that it is a minus sign. So for the whole, you can see the minus in front before it. So I need to put here return, so that's less return inward. Less return inward. So you have to know, what that return inward means. The sales you made, there was a return. So if the reward return, it will reduce the sales. So which we have here. So or the total net sales for the year. When it's signed. So we have 173,950 for the total net sales. That's for the sales aspect of it. We are still working at the trading part of it. So if this is sales, now let's now go to the purchases. What happened? Opening stock. The stock left last year. You are carrying forward to this year that you want to sell. So we have the stock here. Mind you, we have two stocks here. We have stock here in the trial balance, and there's another note downstairs that says stock at close. It means closing stock. So opening stock. So if this closing stock as at 31st December, as at 31st December 2023, if that is stock as close 30,000, it shows that when it comes to when it's the following day, which is 1st January 2024, this closing stock will become opening stock, because that is the stock you are bringing 2024 to start your business operation with. So it's from your opening stock in the following year. That's the next day. Well, we have a stock here. So this stock here shows that it was the closing stock of last year that was now brought for 2023. So we have the opening stock. So just let's have the opening stock. Opening stock. Our opening stock is 23,680. 23,680. Good. Let me quote it so I know how to use it. We don't miss any line item. After opening stock, what are the purchases you made during the year? Purchases. Where is purchases? You can see purchases. Where are you? Okay. Is 100. So let me just put purchases here because there are still some things to adjust some of those purchases. 118,740. 118,740. That's the purchase of goods for the year. So let's see if there's gonna be any carriage inward. If there's any carriage inward. Carriage inward here. Carriage inward here. So carriage inward. I think when you purchase those goods, the cost of carrying it to your company, had the carriage inward. Cost of carriage inward, carrying it to its destination. You need to add it to your purchases. It's very important to add it to your purchases, which is 3,100. 3,100. You need to add it to it. So this makes your total purchases. That means even if you want to sell, you can't sell below. You can't sell below this amount. You cannot sell below this amount. So that's our purchases. So then from those purchases, maybe you discover that there are some goods that are not good. That's our return outward. Return outward. You can see how you have return outward. So you discover, just as you have your return inward from the sales your customer sent to you, if you can send back to your supplier that this is not okay. This is not what I ordered for. So it needs to be taken off from my purchases. So let's return outward, sending it back to the manufacturer or to your supplier. Minus, once you are lesson, just put a minus side it, or you put it in brackets. How much is our return outward? 3,220. So what's the total of this? So we're having 188,620. So we've adjusted our purchases, everything we need to do. Let me just bring it down to this column here, to our opening stock. So opening stock. So as you can see, opening stock of 23,680 plus our purchases after doing all the adjustments and everything. Our purchases, which is a 180, 118, 620. So all these two together shows every product we have, commodity we want to sell, last year own and this year own we bought. So this is cost of goods available for sale. These are all the goods for the year. These are all the goods for the year that we want to sell. This is the value of it, the cost value of it. So this is one, so you can call it cost of goods available for sale. Good. Cost of goods available for sale. Mind you, we did not sell all these things. We did not sell everything finished. That's why we are having closing stock as at the end of the year. Closing stock. So we didn't sell everything finished. So let's remove the one we did not sell. The one we did not sell, which we say stock at close, 30,000 naira. So less closing stock, less closing stock, which is 30,000 naira. So if all these are the products available to be sold, and at the end of the year, we did not sell 30,000 out of it. So what's that telling you? What's your instinct telling you? This 88 is. What is your instinct telling you? This 88 is. What is your instinct telling you? This 88 is. So 88 now shows the cost of goods sold. It shows the cost of goods sold. That's what it's showing. It's telling us cost of goods sold. So we now have cost of goods sold. This is the cost of goods sold. That's what we have. Cost of goods sold. So I can bring it under the sales. And just bring it down under sales. So for us to determine our gross profit. Sorry, this did not come together. I'm still having, so 188 cannot be, so we have to form the stock, opening stock with this together with it. That is, let me just do the equals to opening stock plus these purchases. Good. Good. So you now have, so this is not the right calculation. So always ensure that your arithmetic calculation is correct. So you always try and find out, because if you miss it, if you don't get the calculation, sometimes you might discover that at the end of the it, or it will not balance. And you will not know that these are errors that will affect balancing your financial statement, your account. So the total cost of goods sold is this. As you can see, that means we sold, the cost price of all the products we sold is 112,300 naira. That's the cost of the goods we sold. And that cost, when we sold it at 173,950. We sold it at 173,950. As you can see, 173,950. That's what amount we sold it. So, which will now let us determine what our profit is. Our profit is. Our profit. So, as you can see, it's a profit, not a loss. But mind you, it's a gross profit. Gross profit. It's a gross profit. Gross profit. Gross profit. That is to say, equals to these sales minus these purchases. So we're having a profit of 61,000 and your body. So the company is good. The company is doing fine. As you can see, we need 61,650 profit. So company is doing fine, but it does not stop there. So let's now go to the expenses aspect of it, because all this one we talk about relates to the trading aspect of it. So let's look at all the expenses now. Incurred also expenses. Expenses. So let's go back to our question. We have capital. Capital will always be in balance sheet. Drawing will always be in balance sheet. That's I didn't touch it. Debtors will always be in balance sheet. Carried outward. Carried outward. This is a profit and loss. This is a profit and loss item. Carried outward. Carried outward. So that's this. So sometimes you help your customer. You help your customer to carry their goods. Maybe they bought a particular amount of goods. So you say you pay for the transport, thereabout. So it's an expenses you incurred. So it's an expenses. So just put it under your expenses carried out for this. How much? 2,000 naira. One less creditor will always be in your balance sheet. Purchases, it makes use of purchases. I didn't quote it. I didn't color quote it. It makes use of purchases already. So rent also, you pay rent and expenses too. You have to pay rent for what you are using, for the place you are using, if it is not your home. So rent. General expenses. General expenses, that is 3,040 naira. General expenses. Expenses, 3,040 naira. What next? Insurance, also an expense too. 3,140. Insurance, 3,000. Insurance, 3,140. Yeah. Motor vehicle. Next one. Motor vehicle. 1,140. 1,650. Motor vehicle, 1,650. Premises. Premises is a balance sheet item. So premises is a building. Lightning. Lightning is an expensive. So we note again, you must know all the items that need to be in balance sheet and items that need to be in profit and loss account. You need to know all those ones. So these are all these ones are daily operations that you are putting in on. They are expenses. Salary and wage, we all know that one for sure. We will laborize you for his wages, as it's been said. Salary and wages. Salary, you always want look at your financial statement and look at this in order to know the tax, the payee needs that needs to be collected. Cash at bank, this is not a P&L account, it's a balance sheet. Motor vehicle, the balance sheet. Pointing and fitting, the balance sheet item. Office expenses, this is a profit and loss item. Office expenses, 2,060. So, is there any other? That is all. That is all for the expenses. So let's sum it up. What's the total figure for this? Total figure. Oh, we have 37,420. So this is the total expenses. Then we bring it up to under the gross profit for us to determine is it net loss or net profit. So looking at this, you can see it is a net profit. So the company also performed very well for the year 2023. Okay. Okay. So let me put a minus sign. Yeah. So the net profit will be difference between B and B. Oh, okay. Yeah. So this is our net profit. So the company made a gross profit of 61,560 and made a net profit of 24,230. So if we are comparing it with last year's one, we will know if our profit is increasing or is reducing. So just to know, let us know if there's progress or not. So that is that for the trading profit and loss account. So this is what that will be carried to the balance sheet. 24,230. So let's do our balance sheet now. Balance sheet or call it statement of financial position. Balance sheet as at. So the last day, 21st December 2023. Mind you, X, Y is limited. X, Y is limited. So let me also arrange it well. Let me arrange it well. Yes. Thank you. So Let's have our fixed asset. We call it fixed asset or non-current. In case you see some financial statements, most likely you won't see fixed asset any longer. You see current, non-current assets. That's what you will feel there. So what are our fixed? So we'll come back. Sorry for the network failure. Let me try and share my screen. Uh, oh, okay. Okay. Let me share my screen. So for oh, okay. Oh, yeah.
Are you able to see your screen?
Yeah. Can you see the two? Okay, it's only
Yes,
one.
I can see your screen. I can see your screen.
The two windows. Or it's only just one window. I think it's only showing one window.
Just one window. Just one window.
Let me try and share the two windows. Okay. Yeah. Okay. Okay, good. I guess it's showing the two windows now.
Yes, it is.
Okay, thank you. So before the break in transmission, before the network issue, so I was talking about balance sheet. So we all know what will appear in the balance sheet. So we said premises, which is can be likely to be building 38,620. 38,620. Then we have the Naira sign also on this. Is okay. So let me centralize it. So the premises. So for the premises, it's 38,620. 38,620. That's for the premises. So one next is also now look at what else? Let me start from the beginning. Then we have motor vehicle. Cash will not come next. Cash advance will come last. So motor vehicle. So let's pick up motor vehicle, 41,000 naira. So under non-current asset, motor vehicle Motor vehicle, 41,000 naira. So we have your furniture and fitting. Furniture and fitting, 2,500 naira. Furniture and fitting, internet. Furniture and fitting, so we have 2,500 naira. 2,500. So we have your cash advance, but that will not form under fixed assets. As you know, we said fixed assets are assets that last more than 1 year. They are assets of more than 1 year. So let's have the total of this. You all know our total. With this, we're able to know our total fixed assets, which is 2,120. 2,120. So then let's have our current assets. Current assets. Current assets. So our current assets, we all know that within a year, all our assets within a year. So we pick the stock, start from stock when you arrange it in order of permanent. Stock conference, that's the stock at close. That stock that was remained in our trading account at close that we left. So balance sheet tells us the remaining stock available in your store. All the goods that are still available in your store. That is what this one is saying. Stock. Let me just put stock. So let me put that one here. Amount 30,000 naira. 20,000 naira. You have your debtor too, those going on. Those going on. Put it there. Debtor. It is 38, 9, 30, this 38, 960, 38, 960, 38, 960. Then you have your cash. Cash at bank, which is 4,000, 4,820, 4,820, 4,820. So we're almost through with all the items. So this is our current asset. This is our current asset. Here's our current asset. So what will be our total asset? Our total asset is summation of the fixed assets and current assets. Summation of the non-current assets and current assets is our total asset. I can bring this, drop this down underneath this for us to be able to get the total of our total asset. So for us to these non-current assets plus these current assets. So we're having 5,000, 55,900. So that is our total asset. This is asset equals to capital plus liability. So we've gotten the asset per asset. So then the other asset, the remaining part, we have your capital. As you can see from the question, capital is 126,000 naira. Let me just say it here. 126,000 naira, 126,360. That's our capital. So the amount you invest in the business, which is it. Then 9 days drawing. So the man is the owner. Decides to let me just take small money to do one or two things for personal use. Drawing. So if it is drawing, you know you are removing. So drawing. So 12,000 naira from the question. 12,000 naira from the question. So we are going to remove it. Then net profit. Let's not forget our net profit here. Now we got this our net profit. We need to bring it to the balance sheet. So it's part of the owner's money. That profit is also its own too. The company's own too. So we need to know the position. So you add it to this also. This is how much? 24,000. 24,230. 230. 24,230. So what's the total here? So we have 138, 590. So what else do we still have? Okay, creditor also. So that is we don't have current liability. So we don't have long-term liability as we have explained. So we only have current liability. That's the one within the obligation, payment within a year, current liability. So current liability, which is our creditor. Our creditor, which is 17,310 euros. So our asset, which is 155, our asset is 155,900, must be equal to the summation of this capital and this liability. So if you sum this up to give us the same amount. So 155 on both. So 155,900. So this tells us that all the money the owner has with the creditor was what we used to purchase all these ones at the top here. So balance sheet. So it has to balance. The total asset equals to the capital plus liability is the same 165. So with this, we can see that, yes, we can see that the final account has been prepared. So every account, every company will always prepare trading profit and loss account. We call it income statement of income, statement of profit and loss account, and they prepare balance sheet, which is also called statement of financial position. So these are the two major accounts which all stakeholders will always want to look at to be able to make decisions. So this is the question we have treated in here, as you can see. So our balance sheet balance, we have the 155,900 and from the assets and 155,900 from the capital and current liability side. Then before we call it a day, there are some things also. So it's not just about just looking at the financial statement and saying, okay, that's all. So what are the calculations? What are the things to look at for you to be able to determine, okay, should I still go ahead for you to now make some decisions? So there are some ratios that is being looked at. So to know if this company, to just check the health of the company, if this company is doing fine or not. So there are some things you look at. So for example, so when you look at the profitability of the company, how profitable the company is, you always want to know. So the management always wants to know if the company is profitable. The employee wants to know if the company is profitable. The owner wants to know if the company is profitable. They always want to know all this. They always want to know all this. So what are the figures to look at? What are the indices to look at? So from the profitability ratio, profitability ratio. So we have the gross profit. Sometimes they want to know the gross profit ratio. Gross profit ratio. We always want to know the gross profit ratio. So what's the gross profit ratio here? Gross profit ratio, the ratio talks about gross profit over the sales or the revenue times 100%. So that's what we know the gross profit. Let's know the ratio. Let's know the rate at which we made the profit. Our gross profit is 61. Let me bring this close here. So our gross profit is 61,000. 61,000. I'm trying to look at it. 2 times 650 over the revenue, our sales for the year, which is 173,950. 173,950. So we just divide it. 173,950. I hope you can see my screen. Let me share it. Okay.
Yes, I can see your screen. I can see your screen.
Okay, all right. So the gross profit, which is 61,950, divided by 173,950. So what do we have? Where's my calculator? Let me use my phone calculator to quickly do that. So that was 61,650 divided by 173,950. So let's not forget to be times 100 times 100. That put it in percentage. Put it in percentage times 100. So they'll be having times 100. We'll be having 35%. 35%. So 35% is to tell you that they made the sale. So the percentage of profit they made is 35%, which is okay. That tells you that for every 1 naira, they were making about 35 kobo. For every 1 naira of sale, they are making about 35 kobo from it. So from the sales, they are making a profit, a gross profit of 35%, which is very okay. So let's now go further again to look at the net profit. Net profit ratio also too. So looking at the profitability, net profit ratio. So that will be the net profit. What's our net profit? Which is 24,000. 24,230 divided by sales. 173,950 times 100 times 100. So 24,230 divided by 173,950. So times 100. So it means after factoring all the expenses removing it, they are having about 14% as their net profit ratio. You can see the gap. So it's still fair enough for them. So these are things users of financial information want to see. They want to see. Users of financial information want to see. Okay, so that means they make a profit of 14% for the year based on using an input of the sales. So, and people sometimes you have the thinking that you want to make like 20%. That's what you want to make. You want to make 25% and everything. One more last profitability ratio. We have return on capital employed. Return on capital employed. So we'll be talking about net profit. That will be talking about net profit over divided by what's our net profit? So we're looking at net profit, which is 24,230. So divided by the capital we employed for the business, all the assets we use. So all the assets we use. So sometimes we we always want to use um sometimes we use the total asset. It depends on what you're looking for. So the total asset is 155. So 155, 155, 900. 155, 900. So if we use this figure, it shows that included is also our creditor. 24,350 divided by our total assets, 155, 900. That's all assets you employed for the business, you put into the business. That's what it's saying. All the assets you put into the business. That's what it's saying. It's times 100. So putting it in percentage. Putting it in percentage. So we have 15%, 15.5%. That tells you that. So this tells you that all the assets you have, you're able to realize, you're able to have a return on your investment about 15.5%. That's what it's saying. All the investment, all the money you put there, both the one you have, both the one you borrow, when you channel into the business, it was able for that year, it was able to bring back to you in return 15% and everything. That's what it's saying. So you make to make another decision. Next year, I need to maximize those assets. I need to ensure that I deploy those assets well so that it gives me more return. Just like when you make investment too, you capital you give, you are expecting a return from that capital when you invest in one or two things and you at the end of the month or at the end of 6 months or a year, you look at it, you see that what you're being given is so amount, maybe just 10% that came into it again. So that's what this also is saying, return on capital you employed into it. So all the money you invested into it, so you was able to generate, you're able to generate 15% based on your profit, 15% of it. So you can still try more to ensure that you get more. You achieve more percentage the following year to make decisions to go higher. So as I said, you make use of 155 because you also factor in creditors. You also factor in the creditors. Sometimes you want to remove the creditors that your own money. Sometimes so you know that when from your creditor will always want interest. So because from our balance, from our profit and loss account here, there's nothing like interest paid. Yeah. So let's assume interest has been paid or there's some kind of interest paid. It will have reduced our profit of this 24,320. If the interest, let's say the interest is 2,000 naira interest. So that means you've already settled this creditor, his own, that is out of the profit, 24,320. Creditors has already collected his own interest, 2,000. So which will have reflected in these expenses. So we assume, we now assume we now have 22,320. So you now say 22,320 divided by, you will use the total again, the total asset again, because you've already given creditor their own interest. So just factor in your own. You just divide it by the 138,590. So to know how much that generates to only you generate to only you alone. So that is for that based on profitability ratio. We also have the liquidity ratio too. Sometimes the company can make profit, liquidity ratio, but might not have any money at all. The fact that company is making money does not mean might be liquid. So, and when it comes to liquidity ratio, it's very important because this is where the creditors wants to look at. If you are able, you'll be able to pay them back the money you borrowed. So they will always look if you're able to pay them back the money you borrowed. So what are the things you look at? What are the figures you play around with to know the liquidity ratio? So we have the working capital. That's where the working capital is. You know, when you say you don't have any working capital, A company that does not have any working capital, then it must be suffering. Then the health is shaky. So you can call it working capital or capital ratio or current ratio, working capital. You call it working capital, you call it current ratio or current ratio. You can call it that. So what does this say? What is this one saying? So it's telling you that your current assets, because the working capital means your daily operation. So if you look at our current assets here, you come here, see our current assets here, and our current assets is 73,780. That's our current asset. These are our money for within a year. So divided by current liability. These are current liability. That's the amount we are owing people. We are owing those people. That's within 1 year. So if you have our current assets to be 73,000 plus, and we have our current liability to be 70,000 plus. So if today the creditor says, give me my money, give me now my money, now. So you look at your current asset, you say, I have 73,000. So you are good to go. You are so fine and good, no shaking. You're free. You don't have to have any sleepless night. So you'll be able to pay back. So this shows that this is healthy. No. Creditor will always see this and say, oh, okay, if I should ask my money now, this person will be able to, this company will be able to pay me my money. Saying this person can pay. If he can pay, this person is a credit worthy person, he will be able to pay. But assuming the creditor is almost going to be 80,000 and we have 73,000, then you know that there's going to be a great problem, because if the creditor says now that you pay me, where will you be able to get 80,000 when your working cap, your current asset is even showing less than 80,000? So that means to say, most likely you will even want to go ahead and selling some of your assets. And when you start selling your assets, it means the company is folding up little by little. That's how it works. Seeing company folding up. So that you now start doing restructuring. Let's do this. Okay, let's do this. Let's try and structure. Let's try and sell more shares to the public to get more money so I able to fill those bills. Let's ensure that we go the liabilities we go for a long term. We don't use short-term funds. We don't use short-term funds for long-term projects. So they start doing restructuring. So thereabout, are we going to bench, what do they call it? You bench some, you cut the salary so that we're able to afford some things. There will be enough money for the daily operation and everything. Because salary must go on, life must go on, rent must go on, all those things must go on. You must have money for those things. And that will only show in your stock, debtor flow. And you can even go ahead and call your debtor, pay me my money, and you get it back. And your cash will have to be able to settle your creditor. So that's working capital. So these are figures they play with to be able to know if really I can go ahead to invest in this company or borrow this company this money. And those who have borrowed, okay, this company will be able to pay back. Will be able to pay back. Our current asset is 73,780. 73,780 divided by our current liability. Current liability, which is 17,310. 17,310. So what do we have? 17,350. 73,780 divided by 17,310. So we have about 4.2. That's approximately 4.3. It means that the owner of business can even pay the creditor 4 times. 4 times, no shaking. He has the money 4 times of what he's owing based on current assets that's within a year. He has the capacity of paying even 4 times. So that means it's very, very okay. The company is okay. So it's good to go. It's progressing. Company is progressing. So we also have the quick asset ratio too. We have the quick asset ratio, or we call it the asset test ratio. Let me just stop at this place for liquidity. Asset ratio. Asset ratio is telling us that it is the same the same formula. That's your current asset divided by your current liability. But quick asset means quickly now, because we know we cannot sell our stock instantly. We cannot sell our stock instantly. So let's remove stock. The remaining aspect of it, let's see if we can able to fulfill our financial obligation within that year. So that means it's going to be current asset. This is 73,000 minus this 30,000. So you remove stock, because you cannot easily go ahead and sell your stock instantly. It is very not easy to start selling that. So you remove stock, you now be the debtor and cash, which will now be 43,780. So just to see if truly we can still pay. If truly we can still pay our credit of 780 divided by 17,310. Good. So this shows that yes, we can still pay. So come what may, not anything that wants to happen, we can still pay our creditor. We can still pay them 17,310. So that's about 2.5. About 2.5. Then we can still pay our creditor 2.5. But the moment the creditor, as I said, your current liability is almost at par with your current asset or higher, then something is wrong. You need to run, or things need to be done instantly, else the company can fold up. The company can fold up. Structure needs to take place instantly. So that's for liquidity. And we also have other ones like your debtor collection period or your creditor collection period or your debtors. You must know the period at which you need to collect it. You must not be too long. If it's getting too long, that's what affects liquidity too. You must ensure that maybe it's going to be 3 months, every 2 weeks, your debtor needs to pay. And you have to do some things to ensure that they pay. Either you do trade discount for them. If you can buy in this stock quantity, the discount, it will be discounted for you. You pay at a better price. For them to be able to pay fast, promptly, or if you can pay within so period, you don't need to pay this amount. We'll discount you about 5%, just to encourage them to pay instantly, because you need this quick payment for you to be liquid enough to continue to run your operation. This is very, very important. These are the things to ensure that your company continues to grow higher and higher and start making decisions to ensure that the company grows fine and fine. So this is where I'll put a stop to it, and I want to encourage us all. Go ahead, look at some financial statements. Look at it. Look at their profit. Calculate it. If they're really making you profit, you can compare it with the last year whole. If there's a progress or there's no progress. So check to see. Compare with other banks to know which bank is doing well. Other company rather in the same industry can check assets and GT Bank, First Bank. Look at their financial statement. Look at their profit. So you know which one is doing fine, which is not doing fine. Look at the percentage, how much they are gaining and everything. Look at all these things. So if at all they now tell you, they now start telling you, okay, come and buy shares, you know, look at the liquidity, you look at the profitability. So there's also profit ratio for investment ratios too, that you look at if you need to go ahead or not. If you want to work in one bank or the other, even though all our banks are very buoyant, sometimes you look at their financial statement. Can these people able to pay me what I want? You look at their profit, how much they are paying, how much profit they are making, thereabout. So these are the things you look at, interpreting it and making decisions. Interpreting it and making decisions. So thank you very much. Thank you for this, and I wish you the very best in your future endeavors, especially when it relates to accounting. Especially when it relates to accounting. So I believe you now have very great knowledge about accounting now and what you should look out for anytime you see. So thank you. Thank you. Call it today. Yeah, thanks so much. Madam Eddie,
All right. Yes, okay, thank you very much, Sam. It's been a very insightful concluding part of today's
Okay.
class, and you've made accounting very interesting. I mean, it's easy to learn. I remember back in school, I wasn't an accounting student. It doesn't interest me because, of course, it was stemming from the lecturer at the time. Or from the teacher at the time. So, but you've made it so simplified. So thank you very much. And I hope everyone on the call enjoyed the class. And yeah, we've come to the end of today's session. So thank you. And to everyone else, have a wonderful, wonderful weekend ahead. So thank you, Sam.
Thank you so much. Thank you so much, Madam Eddie. Thank you, every one of you. Thank you so much. See you next time. We're looking forward to the next session also again. I'll be so glad to hear you beforehand.
All
Thank you so much.
All right.
Thank
Thank you.
you.